So I think by way of introduction, we want to be talking, I want to frame how we think about risk in the stock market. We'll talk about risk, the evolution of thinking about risk, probably since the crash of '29, since that influenced and still influences people. You know, how many of you, my father was a college student in '29, and let me tell you, I grew up with parents who were always waiting for the other shoe to drop, no matter how good it got. And it was in the water. I didn't absorb all of their lessons. I'd like to say I did. It's more of a do as I say, don't do as I do. But you could always tell, no matter how good it got. He worked for Eastman Kodak. And this was in the era when the guy went to work for a company, and all these perfectly educated women who had jobs in World War II suddenly were sitting at home, expected to, Mad Men, Wellesley grad, expected to enjoy recipes. But it was this one-time sort of economic boom, right, relative to the rest of the world. We had the factories. Nobody had any factories in Europe anymore. So there was this golden age of the 50s. But people were always waiting for the other shoe to drop. And Schiller was one of those people. And that led him to special situations in investing because he saw the devastation of the Depression, and he was absolutely averse to risk. His children inform me, yeah, Dad didn't talk about his work much. He just really didn't want risk. He really didn't like risk. And they're in their 80s. And like, they remember a lot of wonderful things about him, but this is the thing. Don't take risks. Well, you get up in the morning and it's a risk. How the special situations solution works, and then how it works today, in my view, how I practice it, and then some questions. So, risk. Our view about risk is defined by age, family, employment, life situation. And I like looking at this because we all make assumptions that we don't necessarily re-examine. We're afraid of something. Well, why are we afraid? Or we're greedy about something. Why are we greedy? Is it an information cascade? Is it that we're picking up all these bits and pieces from news around us and we suddenly have a feeling of unease? Does that cause us to be emotional or unemotional? Or emotional when we should be unemotional? Where does it come from? For a certain era, it was the Depression. It cannot be described. My father's father, my grandfather, had a job in the Depression. If you had a job, you did great. You didn't have a job, it sucked. My mother, on the other hand, who grew up sort of comfy merchant class in Manhattan, her father had a drugstore at 43rd and something. We still have a bottle of probably some codeine-laden cough syrup from that, when you could get it over the counter. He died, and my grandmother had bonds, because you didn't have stocks. I mean, yeah, you speculated on radio, RCA, or telephone, AT&T, but widows and orphans had bonds. Of course, bonds got killed, too. So my mother, they lost everything. My mother and my grandmother had to move to Rochester and live with relatives. Nothing worse. I heard about that forever. She would take this is a woman who was, my mother was slated for Vassar. They lost, #1 in her private school class, Catholic girls' school in New York. Lost everything, ended up going to Rochester Business Institute to be a secretary. And when I think of the number of women for decades whose talents were, all right, well, let's not get into all that, but you know what I'm saying. And she led a fairly happy life, but I mean, I think it was a real bring down to go from what she was expecting to being a secretary, going in on the milk truck from Avon, where my grandmother ran a hotel to make ends meet, into Rochester every morning. And she liked to tell me she had 2 dresses. And she'd wash and iron one night or whatever, and then wear the other one. And she said, Tom, young woman in the 30s, 40s, 2 dresses didn't cut it. And I grew up with a sense of the Depression. My grandfather wasn't really better off before the crash than my mother's side, but he kept his job. And so it was this is all stuff we've learned anecdotally, but it was in the water for me. And I heard these stories, but it was always sort of like, no matter how many years Dad was at Kodak, well, you know, you never know. And then, of course, we know what happened to Kodak twice, which fortunately he didn't live to see. Because in Rochester, it was the Great Yellow Mother. I don't know if you heard. Remember the film was in yellow? It was the Great Yellow Mother. Supported all the community organizations, the university, the hospitals, and today it's a shadow of its former self. All right, post-World War II boom. Boy, if you were starting to invest in 48, 49, 50, 51, you didn't have any problems until 73, 74, basically. It was a real nice time, on average. Inflationary bust. We get, beginning with the Vietnam War, guns and butter. We started seeing printing money to finance the war, and that continued and continued under Republicans and Democrats. You know, I was explaining to a friend of mine today, Gerald Ford and Nixon were doing wage and price controls. Can you imagine? Remember wage and price controls? Whip inflation now? I mean, it's incomprehensible to me. And yet, it was the situation. So with the inflationary bust, going up to Paul Volcker's Fed. Remember 18% mortgages? I was getting 10% on my Merrill Lynch money market account when I was teaching high school, you know. And I thought that was so great. Yeah, except inflation was 18% or something, so I was losing 8% every year, you know. Nobody really gets adjusted, nominal versus real, inflation adjusted. I mean, I might as well, give up just trying to explain that over and over because we just think the higher number is better. After the great moderation, after Volcker, okay, if you're investing then, interest rates are coming down, the money's moving into the stock market. Wonderful until 2000. Dot-com crash, then we have the credit crisis and the Great Recession, and that's already 11 years ago. It's just, time does move faster the older you get. A friend of mine in his 80s said, well, you know, Tom, 1 year for me is X% of my life versus the percent when we were 20. And I'm like, yeah, that's why it gets faster and faster and faster. So March 2009, the market, with some exceptions, has gone straight up for 10 years. And I've been predicting a crash for, I don't know, half of those. I mean, not predicting. I'm not in the business of prediction, but, and Prem Watsa, who's a Buffett-like character, runs Fairfax Financial Holdings in Toronto. He hedged the equity portion of Fairfax, very much like Berkshire, business, insurance, and stocks. 100% he hedged the equity portfolio in 2011. He looked really smart in August and really dumb ever since. And so it's really kind of a mistake to try to gauge that. They say that value investors, of whom I'm one, are always fighting the last war. Right? We're always expecting the last crash. Well, you can miss an awful lot of years of returns doing that. So depending on where you're investing, I mean, most of us don't have that long an investing life. The rule of thumb used to be that people's kids are only out of college or in college, and people are only getting on their feet enough in their 40s to really think about retirement investing. But with 401ks, we're starting, the majority of Americans who save and invest are doing it in 401ks and are doing it younger. My sister told my niece when she got her first job, you know, this right out of Wellesley and just all fresh-faced and going to the State Department and so on. And she said, you will open a Roth and you will fund it every year. And my niece is almost 40 and she could stop now. And people who are starting now at 40 will never catch up. You know, these compounding tables. I actually have it in Rule of 72 in the back there. Just brought a few copies. I always overemphasize demand for books. It's like, oh, I think everybody's going to want my books. No. But the Rule of 72 is a fun book for a college student. I wrote it for the educated layperson, and whereas the Schiller books are, you've got to be a total nerd, that's for sure. We all are influenced by our history, our family situation, and what we lived through in the stock market. It seems obvious, but when I think about I think about my colleagues, who my partners at Huckleberry, who are in their 30s, very hard-headed, solid guys with a very sober attitude towards investing, and they needed to call me in December, and I said, "This too shall pass." I've seen this. I saw the go-go years in the late 60s when I bought my first 2 shares of stock with my dad. I saw 73, 74. I lived through the dot-com crash. I was there. I remember my boss's son was a broker on the crash of 87 that day. It never pays to try to time the market, but another story. So a friend of mine cashed out in the fall of 2007. She just said, "I got scared. I went all to cash." She has not reinvested in the stock market. You have to be invested. Of course, it's how you're invested. What most people want, of course, is all the gains and none of the risk and none of the downsides, and my clients are no different. But that's what you get, right? It's like we joke that what my partners and I mean, look, our clients are wonderful people, but you know how in a field you have to blow off steam sometimes, right? And so one of the things is a checking account that pays 12%. That's what everybody wants, except of course when the market's up 20. So the evolution of risk thinking. I apologize for the fact that the print is kind of small on this, but I will help. So this is to show, and this is the Dow from 1900. Oh, let's try this again just for fun. 1900, right, over here, and then you see the crash, right? And then boom, 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 flat, boom, 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 sort of flat, and then up there. And I think this is a logarithmic chart, though I'm not, no. Yeah, it's logarithmic. That's a whole other thing, right? You want logarithmic, not linear, to really see the scale of returns. At every point, somebody's going, "This is the top. This is absolutely the top. This is the top. The world's ending. This is the top. This is the top. This is the top." Now, I'm not poo-pooing fear. This was certainly a bad time. There's no question. But how many of you know this? That on an inflation-adjusted basis, the market returned to pre-crash levels in 6 years. Now, what we're always told is it took the S&P until the early 50s. Well, we had deflation. And so in 6 years, your market averages were at or above pre-crash. Catch was you had to sell everything to live because you didn't have a job. So it's like a lot of theories and so on, it's great to say that, but I mean, if you had a job, all you had to do was stick with the market. And I don't have any answers to things like cry for your mama, 1929. Nobody does. We're all kind of in the same boat. But did you know that in the late 1880s, there was a worse crash? Far worse. So we think of, and this is again about what's in the water in our home, in our study, in our experience. I was reading this wonderful book called Every Man a Speculator, and it looks at the kind of the history of popular investing going back to the buttonwood, the apocryphal buttonwood tree under which trades were made on Wall Street. And this guy talks about the 1800s. First, I will say, there was a cry for your mama, recession or depression, every 10 years in the 1800s. And maybe it stopped with the Federal Reserve, but then no, not really, we still had the crash. So the 1800s, you didn't expect things to always be lovely. In the 1880s, there was a depression so deep and so long, people were living in Central Park with animals and fires, cooking over fires. I mean, is this comprehensible to you? I read this, and I thought, this can't be real. But by the 30s, nobody remembered that, right? My great-grandfather was born in the late 1880s, so he didn't even have that to pass on to my dad. So at every point, oh, this is the top. This is really the top. It's not, the world is coming to an end. And then, then you get the people who say, told you. Well, as I said this morning, I told you, you cash out. You typically don't re-enter the market. Did I tell it? I think I just told that anecdote. Yeah, right. The woman who cashed out in 2007, my friend, and never reinvested, missing 159 or some percent in the S&P. And if you're reinvesting dividends, or if you're building it in your 401k with payroll deduction every period, you're getting that nice dollar cost averaging. You don't have to worry. See, it's over. See you again at zero. Nope. And that was 2008, 2009. I'm not saying that any of us knows what the future of American business will be, but betting against it has not worked, again, over the long term. Fine, no one knows the top or bottom, last crash always in mind, hence we have value investing. Value investing being concerned not just about what the upside is and blue skies, but how solid is the ground beneath your feet. But value has a problem. The bad rap that value investing gets is you wait and you wait and you wait and you wait, and maybe you've got a value trap. Maybe the value will never be realized. This is the problem with the closed-end fund thing I was saying. If you have a fund that's consistently selling at a discount, you never get the closing of the discount window, the closing to net asset value. And this is the wrap with value. So, in the 30s and so on, you start getting value investors who are saying, okay, what if we get a catalyst? What if we get an event that brings the value home? Special situation investing is born. Now, it's born in a time where there were a lot of bankruptcies in the 30s, as you may imagine, and a lot of them were in utilities and railroads. So you'd start getting a lot of people saying, wait a minute, this is a fertile area. If I buy railroad bonds and the railroad reorganizes and the bonds are worth something, I can make a lot of money. And what happened was, so the gentlemen's club that I described earlier this morning with Ben Graham and Rockefeller was getting broken up. A lot of German immigrants were coming and shaking up Wall Street. They were like, well, I came here with nothing. I really don't care about the gentlemen's club. I am here to make some money, right? And have things be better than war-torn Europe. And it's really, these were the leaders. These were the people that ended up running Bear Stearns, Lehman Brothers, Goldman Sachs, and they got their start doing things nobody else wanted to do. One of them was messy railroad reorganizations, buying cheap bonds of companies that might not die, and public utility reorganizations. And Maurece Schiller was just one of many people who said, okay, these are events. I buy the bonds in bankruptcy. The bonds are still trading, right? And when you come out of bankruptcy, that's an event. The bonds may rise if the company's a going concern and then operates again, and I make money. And this is, I didn't get to this soon enough, but my Red Queen and Alice thing, the wrap for value is jam today, jam tomorrow. Jam yesterday, jam tomorrow, never jam today. You wait, and you wait. A lot of people are like, well, I don't want to wait. So, value with catalyst, just like in a lab. And this looks like everybody's father. Certainly looks like mine from a certain era. I remember his Eastman Kodak business card, which was, of course, a glossy photo. It was Kodak, right? And he looked pretty much like that. He'd go to McFarland's every year and get 2 suits and wear those, and next year get 2 suits. That's what they did. These are his 5 books on special situations, published between 55 and 61. 2 of them are circulating. You'll recognize the covers. They were out of print, and something that I started about 4 years ago was to bring them back into print. I tracked down the kids, licensed the copyrights, and 3 of the books are out on the back table, 2 more to go in the next couple of months, and then I'm never doing anything like this again. Okay. I run like a little publishing company, right? I have a contract editor and a contract cover designer and a contract interior book designer and all this. And I'm happy to do it, but there's not a lot of money in publishing. All right, so you have to be doing it for the love. So Schiller talks about, I want to take out all the risk. I want to buy cheap, and then I want like a catalyst in the lab to bring me this value. So it's as if we're talking about a closed-end fund selling for a discount, and I want somebody to go over there and give that window a heave up and close the discount. So when we talk about growth investing, we're talking about companies where it's operations, product and operations within the control of management, and we're buying and hoping that that will improve. But with special situations, we're talking about administrative actions. Break up into 2 companies, come out of bankruptcy, these events that stimulate realization of value and profits. So his 4-part formula is a corporate action. Information must be available. Well, this is hilarious. This is where you know you're dealing with the past. Right. Our problem today is not that we can't get the corporate information, it's that we have too much information. We don't know what's important. Back then, does anybody remember this? In the Wall Street Journal, there'd be an ad all the time where you could write away for annual reports, and they'd send you the paper. And I loved that in the 60s when I was in my teens. I loved that. I would have all these annual reports. You had to really work hard to get the information. Today, it's everywhere. You can get all the SEC data. You just go to edgar.gov, and there it is, sec.gov. The investment return must be calculable. That's a dream, but we'll see how we came up with that. And the situation must be undervalued. So special situations is a branch of value investing where we say, we'll have a catalyst, like we're in the value investing lab. We'll have an event that happens so we don't get stuck with the value trap and sit around forever. Corporate actions. Oh, that's interesting. I did one of these things. Bankruptcy reorganizations. If you buy bonds of a bankrupt company, it comes out, starts trading again, the bonds are worth something. And why bonds? Because the common stockholders are wiped out in bankruptcy 99.9 times out of 100, except if it's General Growth Properties and you're Bill Ackman and you buy it in bankruptcy and you make a fortune. But most of the time, there's nothing for the stockholders. It's the debtors who run the show. And people have sold off the debt because they think they're running from the stench of bankruptcy, and you can make a lot of money. Recapitalizations, rights and oversubscriptions. These are situations where you own something of a company, you own stock of a company, and they'll say, all right, you have so many rights to buy new shares. And this can be a good investment situation. It's kind of complex. I'm not going to get into that today. I'm going to concentrate on spin-offs because they're the most common and they're the most accessible to all of us. Mergers and acquisitions can be value catalyzing events. Tender offers. Carl Icahn will go out and say, I'll buy every share out there for X amount of money. Or a company will tender for its own stock. Spin-offs. This is the most common, most well-known, and most easily accessible special situation, catalyst event today. Liquidations. Simple situation, companies going out of business, selling everything. It generates more cash than debt. It pays the cash out to shareholders. Others. Kind of a tough picture to see, but I just have to show you because it's fun. So Schiller has a scrapbook. His daughter brings it to our first meeting. She said, yeah, I was going to throw this out, but then you called. I'm like, oh my God. And Schiller kept all these little newspaper clippings and so on of his career. He was totally private, not promotional, but he obviously had this little need to, I mean, who wouldn't? Book reviews, like his first book was reviewed in the New York Times Book Review. Who wouldn't cut that out? So these are a couple of pictures he took. This is his 1959 book in Brentano's bookstore window in New York. And another bookstore here, he has the same 1959 book. Now I'll point out a few things to you. So here's his book, 1959, Special Situations, right there. Sorry you can't see it. Graham and Dodd's Security Analysis, the Bible of value investing, right? I think he was probably pretty proud. Now, in terms of what people remember, I would say maybe they remember this a little better. Then he's got this great thing where it's in a bookstore up here, and this is the Yale Whiffenpoofs a cappella group singing record, Porgy and Bess, and then a Fred Astaire biography. So I think he was obviously very happy with the company that he was in. I think sales were probably not quite as brisk of his book. I'm just saying. Now, in 1997, Joel Greenblatt publishes You Can Be a Stock Market Genius. And I bet, how many of you have ever seen this? You ever seen it in a bookstore? Yeah, a dozen people. Well, this is the first anybody modern in the modern world knows about special situations. And it's a wonderful book, and boy, can he write. And he writes about his record at Gotham Capital using special situations. Well, it's pretty much a retelling of Schiller. Never mentions Schiller, not a thing. He does, in his class at Columbia, he'll show the books around. But this was like a nuclear bomb in investing. It gave value, and since then, value investors have just, special situations are like a known area. But it's a modern retelling of Schiller, whose 1959 book he knew. And to be fair to Greenblatt, I mean, this is something you can read. I'm not saying the Schiller books are bad reading. You just have to be a real nerd. You have to be a real geek. He spent a year at Dartmouth, and this was in the era when, academic writing has always been a little dusty, but you use the passive voice, you never say I anything, and I think he was pretty influenced by that. So 50 years after Schiller, 20 years after Greenblatt, what do special situations mean to us today? Okay, they're a way of dealing with risk. Schiller makes fun of buy and hope. He says, I don't buy and hope. I calculate, I look at how cheaply I'm buying the assets, like at a discount to NAV, and what catalyst in the stock lab is going to get to realize my capital appreciation, get me capital gains. And I'm going to focus the rest of the talk today on spin-offs, because you could do spin-offs all day long. And so I will explain special situation spin-offs and use that as the example for the entire field. And we call this Huckleberry total yield, because again, you have to have a name. Now, spin-offs. Spin-offs are simply the separation of a company into two or more parts. In Schiller's era, it was very interesting. The only time there were spin-offs were when the government ordered you to do so, where antitrust was the concern. Companies did not undertake spin-offs voluntarily, and why is that? How were you compensated as a CEO in the 50s, 60s, and 70s? You were not compensated with option grants as today. The bigger the empire, the more cash. Remember conglomerates? The conglomerate craze in the 60s and 70s? IT&T, International Telephone and Telegraph, Gulf and Western, Ling Temco Vout. All these things I grew up with, and these companies are not around today, at least in that form. And the idea was you just got bigger, you bought a lot of companies, and somehow there'd be synergies. But it was all about building your empire so you got paid more. This was before options and shareholder value were really a factor. And certainly before buybacks became more common. Today, they tend to be voluntary as a way to create more value for shareholders. The theory being that the value of a division or an operation might be hidden within the parent company. But if I split it out into the light of day and investors can see its financials separately, perhaps the value of both stocks will be enhanced. Easy to find, less work required than other special situations. That whole list that I gave, spinoffs is the only one that's really not like you have to be a PhD stock scientist to find. And you can be generally right. You don't have to be precise. Good enough gets you profit. So the theory of the spinoff is, I guess, something like this. You're having the fun single life. I'm going to get into trouble. Then you're pregnant, but the value of the child is unknown. It's hidden within, right? Can't live on its own. But if you spin it out, then all sorts of things can happen, like this. You can have a wonderful, highly valuable spin-off child, or you can have not so much. So there are good spin-offs and bad spin-offs. But the idea is, I mean, it's absolutely apt. The child is born, gains weight, grows, released into the world, can have greatly enhanced value, but not always. So here's a good example. eBay and PayPal. Probably something that almost all of us have at one point used. Selling on eBay. eBay owned PayPal. It was their preferred method for payment for all of its transactions. And in 2015, it separated. eBay spun off PayPal as a separate standalone company. It gave birth. eBay was $28 before the spin. PayPal closed at $69 the first day. So there was an immediate, depending on what the ratio was of PayPal shares to eBay shares that you got, you ended up with some shares worth $69 and your eBay stock at $28. So you had a nice immediate view that the golden child had been born. And today, we have a combined stock price of $133 from a pre-spin of $28. So worked out rather well. They don't all do that. Now, why is PayPal, and you can see the bottom, the PayPal price, eBay price has done almost nothing. The appreciation is all PayPal, and that's because it's an extremely valuable electronic payments network with no inventory, I mean, it's really simple. But it was the first mover, so first movers in new areas of business are the ones typically to back. Now, here we have the other child. This is why did I cross those out? These, maybe so that nobody buys them. This was a Greek shipping company. Don't buy Greek shipping companies. I get into that. This is not a stereotype, but all the major shipping companies, Greek owners, they are in business for one purpose only, to benefit the owner, the founder. Shareholders be damned. So Diana Shipping breaks off its container ship operation. Well, this is what can happen in a bad spin. They're dead. I mean, I think the container ship company is bankrupt at this point. Now, who is the foremost practitioner of spins today? And I'm trying to emphasize in this talk stuff we all can do. So when I look for spins for my clients, I have 20% of their assets in companies owned or controlled, or both, by this man, John Malone. The billionaire media king who turned a small Denver cable company into a behemoth, sold it, and then started his Liberty Media empire. And every single one of us in this room consumes some aspect of the Liberty Media empire, whether we know it or not, I bet. His world is a complex, ever-changing, interconnected world, not unlike Buffett's Berkshire Hathaway, except the companies are separate. They're interconnected by stock ownership, but it's not one big company like Berkshire is. Stock has outperformed, just for fun, Berkshire since its 2000 formation, outperformed Berkshire Hathaway. And Liberty's, a share of Liberty Media, when I looked at it in 2002 and decided it was too complex, is worth 40 times what it was then. Never believe any investment person who doesn't tell you his or her failures. That was one of mine. Also, when Amazon crashed to $9, I said, oh, it's going out of business. What is it selling for now? $1,700? Okay. The companies still have a lot of room to grow. They're not behemoths, the Liberty companies. And Malone is in his late 70s. Our life insurance policy is Greg Maffei, who is pretty much handles all the operations of all the companies. And Malone is sort of the gray eminence. He's on the board. He handles some of the interesting tax issues that lead to spinoffs. But Maffei is his lieutenant and has a tremendous record of managing the Malone companies. Now, what are these companies? This is all the things John Malone owns or controls through his stock ownership. The Atlanta Braves. Now, it's not so much for the Braves themselves, it's for the real estate. The Braves own absolutely prime key Atlanta real estate that has been redeveloped and yielding ridiculous amounts of rents. It's not a REIT, though. Formula One Racing, they bought 2 years ago, had been just flailing under its founder. And they like to buy media franchises with great brands that are being poorly managed. They manage them better, increase the cash flow, and use them to buy back stock. And then they do spins, mergers, and acquisitions, and all sorts of things, because Malone doesn't want to pay taxes. Everything he does is to avoid having to pay corporate taxes. Amazing. Someone who doesn't like paying taxes. Sirius XM Satellite Radio is a Malone-controlled company. Pandora Radio. Sirius just bought Pandora. Charter Communications, big cable company. Liberty Global, internet provider in Europe, big cable operator. You're beginning to see a trend here. Repeat, recurring subscription income. Liberty Latin America spun off from Liberty Global, and that'll be an example I'll be using of spin-offs. Numerous online sites, and then I just threw this in here when I was doing this in 2002 and 3 and trying to figure out if I could figure it out. That Malone owned 50% of McNeil Lehrer Productions. And I thought, well, that can't be a very profitable endeavor for them. But it was probably that McNeil and Lehrer were looking for a way to monetize some of their business. And Malone was like, yeah, that's a good business. I guess. Non-profit. I mean, it's on PBS. How much? No, all right. So I'm not really good with this drawing thing on PowerPoint, but you get the picture, right? So this is an example of a certain kind of spinoff. A classic spinoff is where you get like 1 share of the spin for maybe 10 that you own of the parent. What happens in a spin like that is people, particularly large institutions, you have 10 shares of Liberty Global and you get 1 share of Liberty Latin America. It wasn't like that, but it was close. You just sell the 1 share of Liberty Latin America. You don't want the 10. It's not enough to be worth it to you, and you don't really get it, and you know, Latin America, whatever. So there's a big sell-off, and you see this a lot. But if it's a fundamentally good company, it gives you a chance to buy the spin on the cheap. Liberty Latin America is doing some very interesting things. It's Latin America's, South America, Central America, still have very fragmented telephone, cable, dish, satellite TV, fiber optic networks. They're all very fragmented. So this is a perfect market for somebody like Malone to come in, manage the border, inter-country regulations, streamline, reduce the costs, emphasize the cash flow, buy back more stock. He doesn't pay dividends because he thinks he can do a better job with the cash than paying it out. But he buys back a ton of stock. So this is a spin I think I bought for clients somewhere halfway down, because you never know, right? It just was cheap on a valuation basis. And the CEO, Maffei, likes to say, yeah, this is a 5 to 10 opportunity in 10 years. Well, CEOs puff a little. But when I look at the business, the opportunities are so great. They bought whole Caribbean fiber optic network from Cable and Wireless, which was one of the high-flying internet era broadband companies that just collapsed. So he got it for a song. Now, this is many years later, but he got the network for a song. And imagine what it costs to build a fiber optic network in the Caribbean. These are all very little countries with not a whole lot of business. But Cable and Wireless spent all the money on it, poorly, and he was able to buy the assets cheaply, connecting it with Central America, all sorts of things that will yield more predictable, larger revenues at lower cost. Now, I have to say, another element of the decline here was Hurricane Maria in Puerto Rico. They have an operation in Puerto Rico, several media companies. So everybody goes, oh, Liberty Latin America, oh, Puerto Rico, you know, it's gonna terrible, sell the price off. So that was another factor. But, you know, it's like, I don't know, a fraction of their revenues, but this is the emotion of the stock market. So we have a chance to get a deal. And I'm not in the business of recommending stocks in these presentations, but I can tell you that this is my largest single position. For what that's worth. You can go down with me if you want. But so here we have a spin coming up. So you don't have to get a spin beforehand. With eBay and PayPal, you've made money, but it helped to own eBay pre-spin. Liberty Latin America, the deal was to wait. Gap just announced that they're going to spin off Old Navy, which is their most profitable operation. The spin will be Old Navy. The parent will remain Athleta, a strongly growing Lululemon competitor, I believe. And that's a really good concept for them, but it's a fraction of their revenues. Well, all right, it's not that small. But the Gap, I mean, I still buy my jeans at the Gap, but not a lot of other people do, apparently. Gap Kids, Banana Republic. Banana Republic is just flailing. So the question on this is, will Old Navy turn out to be better when valued on its own? I can tell you I'm not going to be buying this one, but that doesn't mean that it's not going to be successful. It's personally that I find retail brands to be a very, very tough area to invest in. Very, very, very tough. Trends come and go. On the other hand, Old Navy has been very successful for decades. So that's a possibility of something to look at going ahead. But I say that it's retail, you know. People still like to try on clothes, but man, Amazon is just killing it. You know, all right, how is that for a totally unanalytical, subjective sort of statement? All right, now this is another area. When we talk about spins, so I mentioned John D. Rockefeller. There's a whole area of antitrust we haven't seen. So if you kept all the shares of the spin-offs of Standard Oil when they busted up Standard Oil, starting with Teddy Roosevelt's trust-busting era, right? And split it off into the pipeline companies, the refineries, all these different entities. If you had held, of course, all of them, you'd have way, way more wealth than from Standard Oil alone beforehand. And that is something that I think we'll start seeing with Amazon, Google, maybe Apple, and some other companies going forward. Antitrust is not dead. I think what happened starting in the Reagan era and increasing was a viewpoint promoted by some law and economics people at the University of Chicago Law School where I attended, so I got to see these people up front. And it was all very theoretical, and the idea, there was some good stuff, which was, we're now dealing with international markets, and we can't just look at pricing power in the United States. We're competing internationally. So depending on your viewpoint, we've had very little antitrust activity. We've had some, but very little, pretty much since the Reagan years, when the University of Chicago began to write the antitrust guidelines for the Department of Justice. That's a bit of an exaggeration, but not much. I think we're back. I don't think you have to think that Elizabeth Warren is right or wrong to think that Google and Amazon and potentially Facebook are starting to have a certain kind of power economically that might be problematic. I don't know what the answer to that is. I don't think antitrust is an easy thing to do. But I will bet you, not any amount of money, but a fair, something to make it a good bet, that these companies will start spinning off either under government pressure, divestiture, or on their own to create shareholder value. Now, the first guess for Amazon is probably Amazon Web Services, Amazon Cloud Services, because it's not a retail operation. It's pretty much its own company offering, like my unprofitable app that I have is hosted on Amazon Cloud Services because it's great for people like me. It's web hosting for every person and very high quality. Google, $700–800 billion market cap company. Waymo, its self-driving car division, is estimated to be worth $100 billion by itself. What happens if that's spun off? What happens if Mother Google delivers Waymo Child? These are both spins that could be accomplished by the companies. Now, if you're Amazon, what might the government do to you? It might make you spin off all those online retail operations you bought, from diapers.com to Zappos. And who knows what would happen, at that point. But I will bet that if we look back 30 years from now, when I will be gone, maybe not even that long, we will see that a lot of these massive companies of today have had spins where if you just hold on to them, they all lead to greater combined wealth. And if I were, so I'm in the car. Did I tell this story? Yes, but I didn't finish it. So I'm in the car coming over here with my friend Michael and his 10-year-old son. And the 10-year-old son is asking me about stocks. And I think I mentioned this morning that he wanted a stock tip. And I said to him, just buy Berkshire Hathaway and never sell it. And to repeat, I think something I said this morning is, it is almost guaranteed that at some point after Buffett, Berkshire will start spinning off businesses. Because there will be just a limit to the value it creates. And the stockholders come first. Like already, Buffett's starting to buy back huge amounts of stock, and at a higher valuation than 1 times book or 1.2 times book that he had said before. The day they do a dividend, then you'll really know things are changed, because he just refuses to do a dividend because he thinks he can invest the cash better than we can. But I bet Berkshire will spin off businesses. They're already spinning off the first, selling actually, first business ever. I can't remember the name, but I read it like a few weeks ago, and of course the comment is it's a non-core business. Well, all their businesses are, to some degree non-core because they have a diverse conglomerate set of them. And if you start spinning off businesses, at some point maybe you have Standard Oil. So Elizabeth Warren, who's an extremely bright and knowledgeable person and has a lot of practical knowledge, I think that if you get hired at Harvard Law School to teach bankruptcy, when you graduated from Rutgers Law School, you probably have to be pretty good. Not just, because these schools hire from all the same places, right? And I just think she published her way up and was a bankruptcy academic, legal expert, and has a lot of very interesting things to say about the concentration of power. Again, I won't get into the politics of it, but I think history shows that, particularly for our country, when a business becomes a center of economic power that arguably goes beyond the government in power, our government tends to not like that too much. and justifies it with all sorts of antitrust activity. Again, I'm not taking a position for or against. I think you have to look at each company. But I think that when we looked at what Roosevelt was doing, these entities, the so-called money trust, like JP Morgan, these were things that pretty much were almost, they were unregulatable by the government. And they were alternative power centers that were viewed as very threatening by some. Fortunately, the breakups made people better off than before. Rockefeller was way better off when the entities were split. So Google, recapping what I said, this has, and not just Waymo, but people estimate based on what numbers Google breaks out, that Waymo is probably worth about 1/7 of the entire market cap. If it were on its own, it'd be amazing. And what does self-driving cars have to do with search? There's no reason that this couldn't be spun off. And my bet is it will be in one form or another. You could say that you're only paying for the search business right now on a sort of reasonable PE growth basis, and the rest of it all is free. Amazon will probably spin off the web services business. Bezos has hinted at it, but hardly very much. But it makes the most sense because it's not retail. On the other hand, it's the great majority of their net income. Berkshire Hathaway empire. Sadly, when Buffett is gone, I imagine that you'll see a changing of the guard. And some of these enterprises, NetJets, there is no way NetJets has worked out well for them. There's just no way. And I bet that gets spun off. I don't know what else I would say. They'll never spin See's Candies, but Fruit of the Loom would probably be really profitable. But there will be ways, if the stock does nothing, you can bet that they will look at all ways to create shareholder value. So these are all special situation catalysts, spins of businesses whose profitability and potential are hidden within the mother. Now, if you're looking for China, and you're looking for something with spin-off potential for creating great value, and you promise that you won't put in more than a couple % so that I don't get any calls or emails, Tencent is the way to go. Tencent owns absolutely everything. If you wonder, well, I'd like to invest in China, I don't want to buy a mutual fund, I want to pick out certain companies, Tencent is like the venture capitalist of China. They own 20% of this, 50% of that, 30% of this, any company you can think of. And they also own WeChat, the third largest chat platform by users, except when I say it's a platform, it's not a WhatsApp. It's not just texting. You build entire applications for WeChat. If you're in China, you build a payment application on it. All sorts of amazing things that we don't really have a concept of. Just keep everything they spin off. Someday they will spin things off. And also, China, I'm like, well, it's a communist dictatorship with no rule of law. Well, yes, that's why you don't buy a whole lot of it. But if you're the government, you remember how Mao came to power, right? Inflation, people couldn't eat, food was too expensive. People didn't have jobs. People were, what's your biggest threat to power? Yeah, revolution or whatever. But people have to have jobs and people need to eat. And so the government has a great interest in the big companies succeeding. Tencent is the biggest developer of video games in the world, online video games. And you would, or our children or grandchildren, whatever, would know the names of some of these, but I can't remember the franchise. It was Fortune something, whatever. You can tell I don't play these items. But this would be the single company to own on the spin-off, long-term, Standard Oil type thing. Now, they're never going to get broken up by the government, but they have shown a tendency already by having a small dividend and a small share buyback that they actually care about shareholder value. Interesting. Oh, wait. Hold on, help. I thought I had a couple more. Baidu, which is the Google of China, right? The search king of China. They just spun off Iqiyi, I-Q-I-W-I. You like that Chinese pronunciation, Iqiyi? Yeah, I know a few things. And that's the Netflix of China. They spun off about 20%, and they will spin off more. And they, like Tencent, own pieces of everything. Baidu, B-I-D-U. So I would say, if we look at risk, but we want to be in equities, the thing to look for are companies with likely spin-offs and hold them a long time. It offers some downside protection in that these tend to be undervalued relative to their parts. Another way of talking is the sum of the parts, right? The sum of the parts is less than if the parts were all sort of spun off. And I think this is, I call it total yield, because while these companies, while I'm waiting for them to spin, they're paying dividends and raising them, a lot smaller dividends yield-wise than Harvest, and they're doing massive buybacks, which raises earnings per share with excess cash they don't need. So we wait, and then when they spin, I will hold those spins. And I think that if you buy these, this is how you make money off these big companies that people think their best days are over. The S&P in 2017 and most of 2018 until the collapse was driven by which stocks? The FANGs. Facebook, Apple, Amazon, Netflix, not as big, but dramatic, and Google. Those companies are big and huge, but their best days are not over for shareholders because they're paying dividends, they're buying back stock, and they will be split up, voluntarily or not, at some point. And those are special situations. There's a catalyst. We know they have value because the children inside, their value is hidden. We just have to wait. But with the dividends and buybacks, we don't wait and wait and wait and wait and wait. We get value along the way. We get paid to own the stock. Buffett has said he will buy back every share he can with Berkshire B shares under $207. I mean, that's a floor if I've ever heard one. I mean, I will not, basically, I won't let the price go below 207. I will buy back, I mean, he has $110 billion. He could buy back a lot of stock. All right. Where do I find out about spin-offs? Set your Google News alert to spin-offs, and you will get two things. You will get every TV spin-off or movie spin-off that there is, and you will also get stock spin-offs. Read the journal. Go to valueinvestorsclub.com. That's an application-only site, but you can get all their ideas for free after 45 or 90 days. And you'll get every kind of special situation on that list I gave, all the nerdy ones, but you'll also get all the spin-offs, analyzed by people who generally are hedge fund managers, typically small ones, and don't just do everything people say to do. Said somebody who bought a shipping spin-off that went bankrupt. And then my friend Jim Royal, who's got case studies in all the Schiller books, and one of the new ones that I'm republishing, one of the old ones that is the newest that will be republished, Jim Royal does all the commentary. We like to think of him as our Jason Zweig, who wrote the commentary for the Intelligent Investor edition that is so fantastic. So Jim actually found the Schiller books for us. We were working together at the Motley Fool, and he found a PDF of the 1966 Schiller, and that's the one going around with the stock tables on the cover. God, that's an anachronism. And he sent this PDF to me, and this is total Jim. Just sends the PDF, no comment of the 1966 book. And of course, I jump, in my typical fashion, I'm jumping up and down, calling him, yelling and screaming. We found, the missing link. We found the Dead Sea Scrolls. And it was interesting because the PDF was on a site that is known for violating copyright. Because two of the books are still under copyright, the first three are in public domain. So I was in this position of, I hate this guy, he violates copyright law. But if he hadn't done this, I would never have known about the Schillers and been able to undertake this project. So, life is full of contradictions. Anyway, Jim has a site called thezenofInvesting.com, and you can get spin-offs and other special situations there. There are many online sources, but these are two that I am most familiar with. So Schiller lives today through Greenblatt, primarily through spin-offs, but many other kinds of special situations. I would like to say a few words about Schiller now at the end. So he was absolutely, completely risk-averse after the crash of '29. Well, what happened after World War II? There was massive technology transfer from the military to the private sector. And you get Morton Thiokol and Hewlett-Packard and all these companies in the 50s, and they explode. Remember a little company called Haloid? It became Xerox. Xerox has been moribund for decades, but my parents' friends, the Nobles, they bought a lot of Haloid, and they didn't work anymore, starting in the early 60s, for their profits on Haloid and Xerox. They had mostly spent their time drinking. But anyway, they weren't working. Anyway, so Schiller, by '59 and '61, has a new chapter in some of the book called New Era Companies. There's absolutely nothing special situations about any of these companies. They're all growing like crazy. It's growth investing. But he puts them in there and says, New Era investing. And it's kind of like, even he can't deny that the US economy in the 50s is just technological innovation like crazy. And then by his last book, 64, last two books in 66, they're in there. He starts really getting into like the Malones of the world. He calls them empire builders and business barons. And these are people not just building an empire to make more money, but they create more shareholder value. His last book was 66. The go-go years come to an end in the late 60s, early 70s. We get the crash of 73, 74, but the last we hear from him is 66. He dies in 91 or 92, living in Santa Barbara. Had a nice retirement as far as I know, but never really talked about his work. I've not been able to find one client. He wasn't a hedge fund manager. He had individual clients. He was a registered representative, some of you may remember, and an investment advisor. He gave classes. In the scrapbook, there are newspaper advertisements with that picture in it where he says, special situations investing, and he has a class on a Saturday. I mean, seriously, who is going to these things? Who's a DIY investor? This is long before AI. I mean, but you just got to love him. If you read the chapters, his prefaces and introductions, he actually writes these as if he were talking to an educated layperson, trying to teach them. You can see he's all about education. He's not interested in talking to people who already know what he does, but he has this honest view that if I could just get people to see this, I can reduce their risk, and wouldn't that be great? And people can have some romance. Remember, I put up there where you make a lot of profit in a short period of time, but you also don't have much risk. I think he never got over the Depression, but he definitely, a little like Buffett after he meets Munger, pay up for quality, pay up for growth. He was willing to make a few exceptions for that with New Era companies. And with that, we come to an end of this marathon session, and I thank you all for your endurance and attention.